Okay, so good morning, everyone. Welcome to this edition of the Macro Snapshot. For the record, we are Monday, November the 13th, 2023. Not a huge amount going on, guys, but what I want to do is immediately just look at the oil market. Let's just look at the chart here. This is the CL1 contract. And as we all know, it sort of had a heavy sell-off. But what I would say from a sort of a technical perspective here is that if we look at something like a Fibonacci extension, we can see that, it's more or less seems to have been overextended a little bit. We can also see that it got back here to like a sort of a fib level, a couple of horizontal sort of supports here. So the question now is that we're seeing a little bit of support over the last 2 or 3 days. Now, the big question is, who's in control? Is that it? Is that the bounce? It couldn't get down to this level here, which was interesting, 73.85. I think the first thing to do, what I'm going to do is just to break this down, let's say onto a 4-hour chart. And let's just see what the bulls have to do. Because at this point, if we look at like even just this most recent impulse here on the fib, we can see that, yes, there was a big sell-off. Yes, the bulls are sort of running a little bit. But the reality is at this point that they have several hurdles to get through. They need to get through this recent high here, which is just over 77.75. And then you've got all of these fib sort of pullback zones. So say 72.27, 79.30, and then probably the most important one, 80.33. So I think the next thing to do for the bulls to show that, they're taking the baton, so to speak, is to push up through all of these fib levels. And at least at a very minimum, we can't say that things are bullish in any shape or form until and unless I would say we get over this fib level. So it's a very clean level here, which corresponds to that. So let's call it 80.30 on the front contract here, CL1. Until then, all this is just a reactive bounce. And indeed, just from a technical perspective, I hope, I'm long oil here, so I hope this is not the case, but one could argue that, at this point, this is perhaps just like a bearish flagging kind of formation, and there still could be a little more downside. Now, if that's the case, you'd have to maybe do this kind of thing and say that, maybe a retest down into the early 70s is possible. So why would that be? Just a little bit of context here. Let's also just see, we'll put it back onto the daily chart here. So just a bit of context here as well. Let's just look and see what's going on with the curves. Pretty flat, not a huge amount, but if we just look at, let's say, the overall sort of curve here, we can see that, it's basically dead flat here between month 1 and month 2. If we compare that to, let's say, a week ago, let's just look at a week ago. This is the curve here of WTI. Let's just bring that in and zoom it in a little bit. So, have we had any kind of change? First of all, we can see that the price has come down a lot. The outright price has come down a lot. We can see that the shape of the curve has also come down. If we just, which is not, particularly sort of bullish. If we look at CL1 versus CL2, just look at the spread. You can see that, this is just a 30-minute chart here going back, 10 days or so. You can see that at a certain point, like let's say 10 days ago, it was up to 60 cents. It has been relentlessly pushing down, flattening that front curve as the market has been selling off. And you can see that even at a certain point, if we go back to Friday, we had a brief period of contango, just a few cents, but see a contango nonetheless, where the front contract is less than the other contracts by about 6 or 7 cents. Just in the overnight trading session, Asia Pacific and Europe, we've pushed up to, 1 or 2 cents here. So still a very, very flat curve. What's the future? The thing is, we just got an OPEC Plus report just about half an hour ago or so, as I'm speaking about 8 o'clock here on Monday morning. And basically the main points there were, I would say, relatively supportive, relatively bullish, not crazily so. And of course, we have to take maybe what OPEC Plus says, they have a certain self-interest. And the basic points, just had a quick look, was saying that the fundamentals remain strong, according to OPEC. Despite the negative sentiment. They said there's just like a lot of negative sentiment. They said that most of the negative sentiment is due to sort of market speculators and their activity. Okay, we know that the Saudi energy minister hates speculators, but their basic point, and again being reinforced by this by this report, is that the fundamentals remain quite strong, and that this is just like some kind of long liquidation speculation. Now, just in terms of some of the what they're saying, they're basically also talking about China and saying that their oil imports remain healthy. So they're saying that the Chinese imports remain pretty healthy. They're saying that the 2024 demand growth is unchanged. They still keep that at plus 2.25 million barrels a day. So they're saying that going into next year, 2024, they do expect some growth. They keep that unchanged. They say that the growth for this year is essentially unchanged as well. So all in all, relatively supportive, I guess, for the market. The only other news we had of oil over the weekend is some talk that some of the supplies from Kurdistan in northern Iraq, which historically have been shipped through sort of Turkey, it looks though some of that production might be unlocked and might start shipping through Turkey. So that could add a few extra barrels to the market. But really, what the market's trying to figure out in oil, as I say, if we just go back to the chart here, is this just was this just some kind of sort of long liquidation? And that could be the case, that you had a lot of weak shorts getting into the action, on the outbreak of the hostilities in Gaza between, obviously Hamas and Israel. So maybe some of these sort of weak long hands here were forced out, and that was a long liquidation, and that's it. However, as I say, until we get above this, let's say at least this fib level at about 80.33, you've got to remain neutral. As I said, I personally, we are long. So I hope and expect that it will push up, at least hoping for some kind of bounce, maybe to retest up here for, $2, $3, $4, $5. That would be my expectation. But as I say, on a 4-hour chart, this formation, at this point is still, it could be an argument that they could still test down to 74 or even a little bit lower. Let's see how we go today, and keep an eye on the calendar spreads. Apart from that, we have a bit of data. Last week, we had the University of Michigan on Friday, which came in with quite poor numbers, really. We had quite poor numbers for the sort of expectations, the sentiment, the current conditions, and also what will have got the Fed's attention, the inflation expectations were quite a bit higher than expected, about 0.4 higher, I think, for the 1-year inflation. And so this is the problem. We obviously have CPI coming up tomorrow. And to be honest, I think today we might just be in a range kind of day because, of course, the market is very, very focused on CPI tomorrow. And we can see that just looking at it, the basic, where is the market positioned at this point? The market expectation at this point, and by the way, guys, I might do another little video this afternoon just talking about the CPI in greater detail. But essentially, at this point, what the market is thinking is that a month of the headline number should be coming down, and that the core number though is going to remain sticky. So you see here the core number remaining sticky, whereas the headline number coming down, and that's just based on this sort of narrative that energy prices have been coming down, food prices have kind of stabilized somewhat, but services, core services, which is what the Fed and Powell seem to be interested in, are remaining sticky. And that's what Powell was alluding to last Thursday at his comments at the International Monetary Fund, where he said that like there has been progress, but he said that in the core number that remains, there's still a lot more work to do. Does the market believe him? And this is where it gets interesting, because if we look at what the market's pricing, because really the question now is is the Fed going to sort of hike a little bit more? So let's just look at what the market's pricing, and basically what we can see is that for the next meeting, which is December. We've only got 3 basis points here, so 3 out of 25, which is nothing really. It's like a 14% price. Now, is that a little bit low? Probably from a probabilistic point of view, 14% of the Fed doing something in December is a little on the low side. But when we get out to maybe what's more pertinent, let's say, for example, something like January, go here 31st of January, the market's pricing in 7 basis points out of 25 basis points. So that's about 28%. So that's, a shade over a quarter. So let's have a look and just see if that's changed. Is the market reacting? Did it react to, let's say a Powell's comments, and did it react to, let's say, the University of Michigan? So if we put on a 3-minute chart, just going back 3 days, we can see that when Powell spoke, which is on the Thursday at 2 p.m., if you go back here, indeed the market did price up from about 4 basis points, got up to about 6 basis points. So definitely the market was believing, it was slightly more hawkish. But then, as you guys can see, it kind of stabilized a little bit. But subsequent to that, it has been pushing up a little bit. And, possibly that was a little bit on Friday morning, we got the University of Michigan at 10 a.m. That's this spike here. So you see that Powell pushed it up, then it drifted down, and then we had the market going up a little bit more. So definitely since Powell spoke, we had the University of Michigan. The market has priced in another 2 or 3 basis points. Is that something to worry about? Is that something to derail the stock market? It doesn't seem to be. And despite the fact that we had the horrendous 30-year auction on Thursday, where it sort of tailed by about 5.5 basis points, what we can see is that the stock market is, doing just fine. Now, was that sort of Friday? Was that sort of end of week flows something weird? I don't know. A lot of people have been saying that. If we look at the VIX here, VIX down at low levels, that's going to be supportive for the stock market. And if we look at something like the SPX on the cash index here, you've got to say, and what I'm going to do is to throw on just a few moving averages as well, just to have a sort of a sense of that. We can see that at this point, we're above all the moving averages. We're above this, pretty significant horizontal resistance at 43.85 on the cash market. And you've got to say at this point, like there's a bit of sort of blue sky above. So I would say that a minimum we could test 44.60 on the cash, and then maybe up to some of these levels here. Now, do I believe it long term? I mean, what's going on here? We have real yields which are still elevated over 2%. We have inflation which potentially is floating down, but not nearly with the rigor and the pace that the Fed wants. And we have earnings expectations for 2024 which are very high. So, will they be disappointed? On the other hand, maybe we're going to get higher nominal earnings, higher GDP earnings, just because of higher inflation as well. But I'd have to say here, what could derail this? So if we look at the ES chart, that's a slightly different one to SPX. You can see here there is a little bit of overhead resistance. So the bulls maybe today, and especially after the CPI tomorrow, will need to push through this. NASDAQ had a similar kind of point here in the sense that above the moving averages, and possibly we'll want to test this recent high here of 15,700, which coincides approximately with the uptrend. So what's going to derail this? Obviously, the CPI is the one. If the CPI comes in hotter than expected, that could be a very good excuse for some profit taking. We've had a sort of 8, 9, 10 up days on the equities. On the other hand, if the CPI, especially if the core number comes in as expected, or perhaps 1/10 lower, that would definitely, I think, cause a relief rally, not only in the equities, but also in the bonds. But just before we get onto the bonds, just keep in mind, guys, that we see here that this is the equal weight. We can see that the equal weight, the RSP here, is done okay over the last sort of period. But if we actually just the last few days, but if we actually look at this and just go on to, I think I've got a couple of sort of ratios here. You can see that the where are we? RSP, there we are, SPY versus RSP. This shows just how much the overall index, which is basically the large caps, as we all know, the Magnificent Seven, have outperformed. They're doing very, very, very well. So really what we'd need to see for a continued equity rally, apart from the Magnificent Seven, is really the RSPs, like the equal weights, the small caps like the Russells, to do better. And if we look at something like the Russell, we can see the SPY divided by the Russell is absolutely underperforming here. So you see SPY divided by IWM here, the small caps underperforming. So this is really being led by the mega caps, and are they being used as some kind of safe haven? I guess that's what's happening. But just in terms of the bonds, let's just look at some of the bond price action. If we look at what I want to look at here is just, let's say, the 2-year, and just kind of interesting. Let's just have a look at the 2-year. So this is on the futures. We can see that over the last week, essentially just trading in a range here, up and then down, but basically since last Monday, down, 5 or 10 basis points or so. That's not particularly, a huge range. But at this point, you've got to say that the 2 years probably getting towards the lows. Now, could Powell and company hike one more time? Yes. So could we retest these lows? Yes. But just if you look at the yield chart, I think that's probably going to be about the maximum. And certainly the fact that the front end of the curve here is sold off over the last week, that means the market is fairly clean in terms of positioning. And I do believe that if we get an inline or lower than CPI, there could be a big rally on the front end. To be honest, why not also on the back end? We've had the ZB, you see here, much more supportive price action over the last week. That's despite this big candle on Thursday, which was the bond auction. So just again, fairly clean markets here. Let's see again what happens with the CPI. As I say, we'll talk about that a little bit later on. Now, talking about the yields, and the dollar index here coming back. We thought this might be some kind of bull flag kind of situation here, just having a bit of a push up. It's very hard to see why one would sell the dollar at this point. You have the Fed, which is more hawkish than the other central banks. You have the US economy, which seems to be outperforming both, let's say, the Eurozone and let's say China. And so it seems to me that the dollar, especially if we get a bit of sort of global fragility, the dollar should retain its strength here. I don't know that one could be buying it here necessarily, but one would not certainly be selling it. And I think I'm not going to look at the other sort of currency charts, just because really at this point it's a function of the dollar. You can see pretty similar price action just mirrored over in the euros. Looks like it's sort of potentially is just weakening a little bit. The one which is interesting is the Japanese yen here, that we are getting towards recent highs. In fact, maybe we just actually pushed above them. We just actually pushed above them. They're getting very, very close here to that 151, 152 sort of level. People are talking about intervention, but again, the fundamentals do justify this. We still have, the Bank of Japan, no real particular need to hike interest rates at this point, because inflation is not massively out of control at all. And secondly, we saw that the GDP actually slowing down a little bit in Japan. So although a lot of people are clamoring for the BOJ or the Ministry of Finance really must intervene, the reality is that there's no pressing need to do so. And one of the issues for the BOJ and the Ministry of Finance over there is the issue of volatility. And this is sort of more of a grind higher rather than some kind of crazy volatility. And if you look at the implied volatility on the yen, it's actually pretty low. So I do believe that if we get a strong CPI, can the US dollar push through the 152 level? Absolutely. What's going to be the pain point of the Ministry of Finance? Interesting. We shall see. We shall see. But I think for sure the market looks as though it wants to push through that, assuming we get a strong CPI. On the other hand, a very weak CPI or a cool CPI, that could be it's a beautiful level here for just a little bit of a profit taking and a little bit of a breather there. Other things to be looking at, guys. Gold's an interesting one. We're running into a little bit of resistance, technical resistance here. If we throw on a few moving averages, you can see that the fat sort of pink line here is the 200. The next one is the 100. So basically got the congruence here of the 200 and the 100. That was a strong overhead resistance here. It's come down into the fib zone, the 38%. Now, could it drift lower? Absolutely. But as I say, there is a little bit of technical resistance here. We know there's a lot of sort of central bank buying, strong buying by central banks. So it would not surprise me if gold here takes a little bit of a pause, or maybe even sort of starts to creep up a little bit. Again, maybe the CPI will sort of help determine the next sort of movements for gold. Having said that, though, with a relatively strong US dollar and real yields which are remaining at about 2.25%. And maybe the risk premium, the so-called war premium sort of drifting away in the Middle East, there's no reason for gold in theory to push a lot higher. On the other hand, gold has decoupled a little bit its correlations with the US dollar and real yields in the last sort of month or so. So maybe we can't extrapolate too much from that. But at the moment, I think if anything, it could be like a very modest buy here. But I think I'd probably want to wait for a more extensive pullback to, let's say, about the 1900 level or so before dipping the toe back in. So that's about it, guys. Oh, just one other thing I did want to talk about. We have some bit more data. We have retail sales coming up. That's going to be pretty interesting. I think that's on Wednesday. That's going to be quite interesting just to see if the US consumer remains strong. Remember, the GDP was strong a couple of weeks ago. So in terms of whether this sort of famous recession may or may not be coming, whether the US economy may or may not be weakening, we're going to get an interesting read on that with the retail sales. And I think the way to look at retail sales is also to look this week at the earnings from, we have Walmart and Target. So it's going to be and Home Depot. So we have Home Depot, Walmart, and Target, and that's a good read on the US consumer to see if the US consumer has sort of spare cash and is continuing to spend, not just the the top sort of percentile of the population. So definitely that's going to give us a more of a read on just the state of the real economy. Finally, guys, just want to have a quick look at Italy here. Over on Friday, we had a Fitch basically maintaining Italy's sort of stable outcome. What could be quite important here, what could be quite interesting here, if we just look at the spread here between the Italian bonds and the German bonds here, you see that that's come in quite a lot, which is a sign that, you know, of relief that, you know, the interest rate differentials are not going to blow out too much. It's come back into a fib zone here. So kind of an interesting technical level. What is interesting is that we do have Moody's reporting after the bell this Friday, so still another 5 days away. And remember that Moody's just has Italian debt just one notch above junk. If they were to downgrade Italian debt into the junk status, we could expect that this spread between the Italian bunds, the Italian BTPs and the bunds would blow back up out to at least, let's say, the 2%, maybe even, you know, retest up to 220 basis points or so. On the other hand, if not, that would, you know, be sort of a mild positive for the for the Italian BTP. So that's definitely something I want to see how that trades over the course of this week. And that's about it, guys. So as I say, let's just see technically, I think maybe today, just see if the ES and the stocks in general want to sort of push up through those levels, especially on the ES. I'll be watching this sort of overhead resistance here at 44.32. The other thing to look out for is, you know, will the Russell continue to sort of underperform? Let's look at the Russell here, very much underperforming the small caps, underperforming the mega caps. The other thing is just also to see oil. I'm quite curious to see how oil reacts to this OPEC Plus report. Will it sort of, you know, bounce continued from those levels? And that's it. Otherwise, guys, I'll probably be in touch a little bit later today with a bit of a CPI sort of update. And of course, that's the big one for tomorrow. Okay, great. Have a great week. And thank you for watching. Goodbye.